My name is Ron from CM Trading, and I want to welcome you to today's presentation of Forex for Beginners. Before we start, just a little overview about what we're going to be speaking today. We're going to, today's presentation is really going to be a little background about what Forex trading is, what are the important things to know before you start trading, and a little bit about fundamental analysis, and then a little bit about technical analysis. It's a really basic thing. Also, if anyone has any questions, feel free to ask questions as I'm giving the presentation. I love applying questions into the program. It makes the presentation that much better. Okay, so let's get straight to it. Before we jump into trading, we have to understand what leverage is. This is when you trade Forex, it's all about leverage. Now, if you trade stocks, you're going to be buying, basically, if you have a $100 stock, then you're going to be paying $100. You have to have $100 in your account to buy that stock. But with leverage, things are a little different. So what is leverage? So basically, leverage is like trading on steroids. Just like you have those sports athletes that after they take steroids, they're that much stronger, that much faster. So too, trading with leverage is kind of like trading on steroids. So if you're not careful, then this is what's going to happen. Okay, keep in mind this little picture over here, this little image, because this is basically what happens. A lot of beginners, when they first start trading with Forex, they don't understand using leverage so much, and because of that, a lot of them just end up falling off a cliff and not doing very well. So the first thing you got to know is about using leverage. So let's get it. So based on that little introduction, what is leverage? So with leverage, if you have basically when you're using leverage, you're able to trade with money that's not yours. So for example, if you have $1,000 in your account, then with leverage, you're allowed to trade up to 200 times your money. So if you have $1,000 in your account, with leverage, you can do a $200,000 position. So that's pretty cool. If you have $10,000 in your account, you can trade a $2 million position. It's $1,000 account, you can do $200,000 position, so that's a lot of leverage. That gives you a lot of buying power. So with a little bit of money, you have this leverage to be able to buy a lot. It's very similar, to kind of break it down, like buying a house. So if someone takes out a mortgage, what do? If you buy a $100,000 house and you put down $20,000, you put down a 20%, and then you borrow the other $80,000, so you're really buying a house on leverage, because you're buying a house with borrowing most of the money to buy the house. But with Forex, since you can take a 200-to-1 position, so it's really like, it's not really even trading like steroids. It's like Captain America steroids, where they have like those crazy shots and the serums and things like that. Okay, so what does this mean to you that you can take a 201 position? What this means is that if you have a 0.5% move, even if something goes your way, only goes up 0.5%, then you're going to be doubling your money, and that's pretty cool. That's why a lot of people are really into Forex trading, is because with using the leverage, you can make a lot of money really fast. And that's, so if you make a 0.5% move, you're going to be doubling your money. While if you buy a stock and it only goes up 0.5%, you barely made anything. But we got to remember this little image that we had before. If you're trading and you're not careful with that leverage, then what happens? Just like a 0.5% move can make you double your money, a 0.5% move against you, you're going to lose all your money, and that is not a good thing. So that's what we have to remember with leverage. Leverage is very dangerous. If you're doing 200-to-1, you're taking positions of 200 times the money in your account, then you can really very quickly, and more likely than not, most new traders will lose all their money because they're taking too much leverage. They're falling off that cliff. What's considered safe leverage? How do you want to trade? So let's look on history. So during the financial crisis in 2007, 2009, the companies that really had a lot of problems, the ones that really fell under, were like the Bear Stearns, the Lehmans, those companies that had taken leverage of more than 20 times their capital. So they had, let's say, $1 billion in actual cash in their company, but they had been taking positions that were, of more than $20 billion. And once things started to get worse for them, they quickly, they quickly went under and went bankrupt. Therefore, using that historical example of 20 to 1, so it's worth taking for us, especially for new traders. You want to kind of keep your short-term trades below 20 to 1 leverage, and your longer-term trades between like 5 to 10%, 5 to 10 times. Any questions? Oh, here's a good question. Can you take... So this comes up a lot. Like, let's say you're just in a position and you get excited about something. Can you take more than 5 to 10 or 20 to 1 leverage? So the truth is, yes, you can. If you feel really comfortable about something and you're willing to get out of your position very fast and cut your losses quickly, then you can take higher leverage. But you have to be really, really careful before you start talking about taking more than 20 to 1 leverage. Thanks for the question. Okay, after that little introduction, I hope I haven't scared anybody, but remember, leverage is the real key that changes between the winners and the losers in Forex trading. So what is Forex? For those, ask the question, who here has never traded? Just, click on to raise your hand. Who here has never traded Forex before? Is this totally new? Has never made a trade in Forex? Okay, it seems like a bunch of you. This is their first time trading Forex. Okay, so this is, if you trade a little bit in Forex, this might be a little basic, but for those of you that really have very little knowledge of it, this is we review a couple of main things. So how does Forex work? What is it exactly? Basically, Forex is about trading currencies against each other. It's not buying one currency or another currency. It's really trading one currency against another. Therefore, since you're trading currencies against each other, you always do something called trading a Forex pair. So you can be trading a Forex pair. So instead of buying and selling one currency, you actually buy currencies against each other. So we always trade two currencies when we trade. So we're going to be buying one. There's going to be one that you buy and then one that you sell. Okay, if this is a little confusing that you're buying and selling two different currencies at the same time, okay, so let's give an example. So we have what's called the EURUSD or EUR/USD. It's really the same thing. It doesn't matter how you spell it. This is the EUR is the euro, and the USD is the US dollars. This is you've probably heard a lot of people talk about the euro dollar. It's very popular. It's the most popularly traded Forex pair, and it's also right now in the news a lot that people are talking about the euro dollar. So let's give an example of using our euro dollar. So if you trade the euro dollar, if you decide that you're going to buy the euro dollar, you see the euro dollar and there's a price for it, you decide to buy it. So what you're really doing is you're buying the euro, you're buying euros, and you're selling dollars. If you sell the euro dollar, then what you're doing is you're selling the euros and buying dollars. So what does it mean? How do I make money if I'm buying one currency and selling the other one? So you profit in Forex trading when the currency you buy gets stronger in relation to the one you sell. So if you buy the euro dollar, an example before, we're trading the euro dollar, and then you go ahead and buy the euro dollar, so you'd be making money if your euros get stronger than the US dollar. Okay, but what does that mean that my euros are getting stronger than the euro dollar? I mean, they're really just paper. It's one paper, another paper. So what does it mean to get stronger? So the best way to understand this is to think about money changers. Anyone's gone traveling from one country to another. So as soon as you cross another country, you'll see these money changers that are there to change your currency from one country's currency to another currency. So let's take our guy here, our traveler who's going from Europe to the U.S., or he or she's going from Europe to the U.S., and when they get to America, they see at the airport it says there's an exchange rate of euros $2, and it says 130. What does that 130 mean? So that means for every 1 euro, our traveler would get $1.30. So now we have a price here. We have a euro equals $1.30. on the traveler's next trip, when he gets off the airplane, and now he's back in America, suddenly he sees the exchange rate says 135. Before it said 130, and now it says 135. So that means for every €1, this traveler is now going to receive $1.35. So that traveler, his euros had risen in value. Why did it rise in value? Because before, when he was only getting $1.30 for his euros, now he's going to get $1.35 for his euros. So his euros have gone up in value in relation to the dollar. Now they've gone up in value by 5 cents, 5 little pennies. Does it make sense, everybody? Any questions about this? Okay, so now we know that currencies do change in value. They do get stronger than another. And the way we make money in Forex trading is when we buy one currency that gets stronger than the other. So in our example, we could have bought the euro dollar at 130, and we would have made money when it went up to 135. So now we know that the whole concept of trading Forex is all about currencies, one currency getting stronger into another, just like our traveler who sees different exchange prices every time he goes and changes money when he gets to his destination airport. Okay, so the big question is, why did rates change? You know, we're always hearing about rates changing, the price of a currency versus another is this or that. They're always changing. So why do the rates change so much? Why shouldn't they just stay the same for a long period of time? Or in general, even stocks. You know, you have a stock of a big company. Why is one day it's worth $100, and the next way it's worth $95, and then up to $105? And that can happen over a couple of days. Why does it happen so quickly? So the reason why rates change, whether it's Forex or stocks or gold or whatever, it all comes down to supply and demand. Now, a lot of people are going to come out with different reasons and this news or that news, but it all comes down to supply and demand. And this is very important. I can't stress this enough. If you're new to trading, if you never forget Forex, if you just trading for the first time, the most important thing you have to remember is that everything comes down to supply and demand. On my first interview, when I had it on, when I was just out of college and I was trading at this Wall Street firm, had this big round table, interview. It was kind of like that movie Boiler Room, like that actually happened, and I had that type of interview. And this guy, the owner of the company, it was a legit company, it wasn't illegal like Boiler Room. But in any event, so the managing director sat us all around, and he goes to us, what makes the price of stock move? We all had different answers. Analysts or news or earnings, this and that. And he just looked at us like a bunch of idiots, and he said, I don't know what colleges you guys went to or what you guys learned, but it comes down to one thing. It's all about supply and demand. And everybody, when it comes to trading, if you don't remember it comes down to supply and demand, you will not do well. So you have to have that thing in your head when you're trading. It all comes down to supply and demand. So for us, this means that if there's more demand for one currency, then that will make it stronger than in relation to other currencies. If there's less demand for a currency, then it can make it weaker in relation to other currencies. So it's very important for us to be able to understand how supply and demand works for currencies, why there's suddenly more supply and demand, and also it's very important for us as traders to be able to measure supply and demand. Okay, so a little bit more about this, about supply and demand. Generally speaking, this is not always true, but for about 85% of the time, stronger economies, if an economy is doing stronger, then that leads to more demand for the currency. Why is that so? Why is there more demand for a currency if a country has a strong economy? Because when a country is doing well, then what happens? A lot of foreign investors want to invest in that country. If suddenly there's a country that everybody there is doing, is making a lot of money very quickly, then from around the entire world, people are going to want to open up offices in that country. They're going to want to, just like China. So China is growing very fast, and suddenly every country in the world wants to start investing in China and have workers there and have everything going on there because it's a strong economy. They want to take advantage of that growth. Also, if you have a strong economy, then your citizens are less likely to invest outside. So if I'm in England and I see that the FTSE, that the London Stock Exchange is doing very well and the stocks are doing very well, then I will want to keep my money in England, because why should I bother taking my money out of England when I can make good money on the stocks doing well in the UK? So stronger economies, they attract more foreign investors, and they also keep the domestic money in the country itself. So that leads to a lot of currency demand. Strong economies lead to more currency demand. Now I just want to show you an example over here of where we see a strong economy showing a lot of demand. Okay, let's bring up here's the euros. This is the euro and okay, so here we have the euro and the Swiss franc. So when things start getting a lot worse in the EU in the 2009 time, so a lot of people in Europe started to quickly put their money into Switzerland because it's a neighboring country. It's very easy to get there, very easy to move money there. So suddenly there was this huge, because Switzerland's economy is doing well, there was this huge foreign investment of people in the EU that were putting their money into Switzerland, and that led to the Swiss franc getting a lot stronger than the euro. So what we see here is that the euro in relation to the Swiss franc kept getting weaker. So this is the price of the euro versus the franc. So one time in 2009, 1 euro would have given you over here 1.5 francs. Suddenly in 2 years, your 1 euro was only going to give you less than 1 franc. So at that point, the Swiss National Bank decided to step in, and then they started making intervening, and basically ended this whole situation. But in any event, we see here for 2 years this direct situation where there was a strong economy, and because of a strong economy, suddenly everybody was putting their money into that country. Okay, since we just said that it's very important to understand supply and demand, and strong economies lead to a lot more demand in a currency, so we need to know, how do we measure what's considered a strong economy or not? So what Forex traders do is they'll look at economic reports. They'll look at what's going on in a country's economy. They'll look at employment reports and see if there's a lot of employment in a country, and that means that that country is growing well. They'll look at interest rates, whether a country's central bank is raising interest rates or not. If they're raising interest rates, it usually means that the country is doing stronger. They're looking at manufacturing indexes and inflation reports. So these different economic reports are used to measure whether economy is doing stronger or whether economy is healthier or not. And if these economic reports are better than expected, then often will lead to strength in a currency. Any questions? Here's a question. So the question is, what is most important? So I like to answer the question like, what is the most important economic news? So usually, it's like country specific. So for example, in the U.S. right now, today there's going to be this big employment number from the U.S. So the U.S. happens to be that the employment reports are very important. While for interest rate meetings, countries like Australia, the Australian dollar, and some of the more commodity-based countries happen to be more important. While inflation reports happen to do Also affects the US dollar a lot, but also happens to do with like commodities like gold, move a lot on inflation. So every country you'll see has a different economic report that's really important for that country based on what's going on over there. So it's worth reading. It's very important to read the news. You know, not only to look at the economic reports, but also read the news and reactions. So if you see that, if you read in the newspaper, or if you're reading online that such and such country had a important economic news, but the currency didn't move a lot, then that probably means that that currency doesn't, you know, that economic report is not important for that country. Okay, so we just discussed how are we going to use fundamental analysis to see whether a country is strong or not, the economy is strong or not. Now we're going to look at technical analysis. Technical analysis is used to measure supply and demand, right? A lot of people have this thing, they hear about technical analysis and they look at charts. You could use it to see, you know, whether something's going to go up or down. But really, what it comes down to is that technical analysis is something used to measure supply and demand. It's nothing more than that. It's not some voodoo magic numbers game. It's really about using supply and demand. So just like you use a thermometer to measure whether, you know, to measure the temperature, you use technical analysis to measure supply and demand. What do we use it for? So it's going to show us when something's oversold, when it's overbought, when it's got momentum. So the basic ones we're going to be speaking about are trend lines and support and resistance. The reason why I want to spend some time with trend lines and support and resistance is because if you're listening to commentators or reading about Forex trading, you'll often hear them people talking about trend lines and support and resistance. So these are very important basic chart patterns that are very important to know when it comes to trading, because it will make you more likely to understand what people are talking about. Okay, so the first one we said here is trend lines. So there's two types of trends. There's an uptrend and a downtrend. It's actually called like a no trend, but we're not going to discuss that. We're going to talk about uptrends and downtrends. So uptrends are characterized by having higher highs. We're going to see charts in a couple of seconds. So uptrends will have higher highs and higher lows. Basically what you're doing is this uptrend is showing that buyers are becoming more aggressive. We want to see if the chart is showing us that the buyers are getting more aggressive, and that means that demand is rising. Remember, we're using to measure supply and demand. On the other hand, if you have a downtrend, downtrends are characterized by having lower lows. Things are getting lower all the time, or lower highs. And that shows that supply is rising. Prices are dropping because supply is rising. Okay, so let's look at a couple charts here to understand better. Okay, so here we have a chart that's coming up for everybody of the Australian dollar versus the US dollar. So we see that this thing moved up in the beginning of January till February. It moved up a lot over here. We moved up about 7% or so. And during this uptrend, it wasn't just moving up. It wasn't just like some news that made one big move, but it kept having like these higher lows. Like every time, it was kind of like going to the beach and you watch the waves, right? The waves go up and then they crash down. They go up and down. So we have these waves going on over here where they're going up and then crashing down, going up and crashing down, going up and crashing down. But every one of these waves is getting higher than the next one. So that's very important to us because it shows that demand is getting stronger. There's higher lows. You know, it's not only higher highs, but also the lows are getting higher. So we have this trend line, which is showing us that the demand is getting more aggressive. So the buyers are getting more aggressive, which means that there's more demand. So if we see an uptrend, then we know that there's more demand in that currency. Now, a downtrend is characterized by the exact opposite thing here. We have a euro dollar here that went from the 140s down to the 125s in about 3 months, the end of October of last year to the beginning of January. But this chart here wasn't only moving down, it also had like these lower lows. It shows that there was more supply coming. It meant that there was more supply in the market that was keeping the prices falling. And also the buyers kept backing off. The demand for the buyers kept moving back. So there's less demand, so the prices dropped. So if you see something's in an uptrend or a downtrend, then you could use that to measure whether supply is rising, supply is increasing, or demand is increasing. Any questions? Okay, good. So let's move on to support and resistance. The next key technical analysis item that people watch is support and resistance. So support is used to indicate a level of buying demand in the market, and resistance is used to show a level of supply. So let's see a chart here to understand what support and resistance means. Here we have a chart of the euro dollar, and we can see that this one anytime you have a horizontal line in the market, you see over here this, you could show all the lows of the euro dollar all falling in one place. That shows that there's support in the market. That means that there's demand to buy something in one price. So we see over here, right below 130, right below 1.30 for the euro dollar, there was demand over here that was keeping the price from going any lower. Eventually, we saw that the support fell apart, and then it went lower. But for us in the market, for us as traders, we look at these charts and say, hey, there's support around 130, so that means that there's other buyers in the market at 130. So if I'm going to be buying, this chart will tell me two things. It'll tell me, one, that there's other buyers around at 130, and also tell me that if the price drops below 130, that the demand that was there is no longer there anymore. So it might go lower. Similarly, we have a chart here that shows resistance. We see that the pound dollar was moving higher, moved higher, 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 and then it kept getting stuck at 157. This chart actually went on for a while, a couple more, like another day, that kept hitting up to 157 and it kept finding resistance every time it got up to 157. So what that told us is that there was supply in the market. There was supply at 157. There were sellers there. They're offering supply. They're keeping the price from going lower. So as a trader, that means that there's a lot of selling demand of sellers over there, which would keep me from necessarily buying at that level.